Loblaw recently reported earnings, and I'm going to cover the good, the bad, and where the stock might be headed from here on out. Plus, I'll go over a controversy involving the Buy Canada movement and why it's something you may want to consider before investing in the stock. So let's get to it. First and foremost, the earnings numbers. Loblaw released its latest quarterly results in July. For Q2, the company's sales rose by 5.2% to $14.7 billion. That was better than what analysts were expecting, $14.6 billion and closer to just 5% growth overall. It was a good quarter for the business as Loblaw is one of the leading retailers in Canada, so its business should be fairly well insulated from broader macroeconomic issues. Its business centers heavily around groceries and day-to-day essentials, so Loblaw's results should be fairly stable. Its No Frills brand can be particularly appealing to shoppers looking to save money on groceries. But it wasn't just in-store either. The company's e-commerce sales were particularly strong, growing by 17.5% year over year. On the bottom line, earnings totaled $714 million and were up over 56% as the company incurred higher costs due to intangible assets in the same period last year. So it was going up against some soft comparables, which makes the earnings look stronger than they otherwise might be. The company's free cash flow for the past 12 weeks totaled $468 million, which was also a solid improvement from a year ago when it reported $437 million in free cash. Overall, there were a lot of good numbers from the company's recent earnings report, and there wasn't anything terribly bad that stood out. For a grocery retailer to be generating mid-single-digit growth is pretty strong, and the e-commerce numbers look particularly encouraging. The bad news, however, is that the business is involved in some controversy involving its Buy Canada marketing. Recently, reporters found that the company wasn't labeling products correctly, and those which it said were made in Canada actually weren't, with consumers trying to focus on Canadian-made goods. And if the perception is that Loblaw isn't being all that honest and transparent, it could lead to a backlash. Remember, it was only a year ago where there was a movement to boycott Loblaw due to high prices and perceived price gouging. If that happens again due to this Buy Canada controversy, that could impact sales and hurt that solid growth rate that it's been experiencing recently. But the good news is, just like the controversy last year faded away, the same will probably happen this time around. Because love it or hate it, Loblaw stores are still go-to options for most Canadians. So where does that leave us with the stock? Business is doing well, but it's also important to consider the stock itself and whether it's worth investing in it right now. This year, Loblaw stock is up close to 20%. It's a great performance, and it also pays a modest dividend that yields 1%, giving investors multiple ways to profit from owning it today. In 5 years, Loblaw stock has climbed more than 200%. Not only has it been a good growth stock, but it's also fairly stable, with a beta of around 0.4. This tells us that it isn't very volatile compared to the broader market. That can make it an appealing option for investors who want some good stability. It isn't likely to fall as drastically as the markets, nor is it likely to rally as much when things are good either. But what about valuation? Right now, Loblaw has a market cap of $67 billion. It's trading at a price-to-earnings multiple of 28, and it's at all-time highs. Its valuation is a bit rich for a grocery store that's growing in single digits. But at a time when investors are loading up on safe stocks, it might not be all that high. Consider Walmart, which is usually generating single-digit growth as well. It's trading at 42 times its trailing earnings. And Costco, it's at a multiple of 53. These are incredible premiums that aren't typical for grocery stocks, which normally trade at much lower multiples. I think it's a sign of investors piling more money into safer stocks these days and willing to pay a premium to do so. Overall, I think Loblaw is a good long-term play. And with investors appearing to pay a premium for safe and stable grocery stocks these days, I could see it rising higher, perhaps to more than 30 times earnings. Normally, I wouldn't say it's worth such a premium given its modest growth, but I think this year is proving to be an exception. Loblaw may not be the most exciting growth stock, but it doesn't look all that bad either. What do you think about Loblaw stock? Is it a good buy? Let me know in the comments, and please make sure to leave a like and subscribe for more videos. Thanks for watching.